Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital and excited to be joined by my friend Sam Sahn, Portfolio Manager, Managing Director at Hazelview. Though they're based up north in Canada, Sam based in New York City. We go way, way back, seen each other several times over the past few months, actually. And we've been really looking forward to this. The goal of this conversation is to highlight in similar conversations we've had what are REIT portfolio managers, real estate investors, both public and private, thinking about as far as where's the world going, what sectors are in vogue. Frankly, it's the why. And obviously, we'll go into maybe a couple of their ideas, but I think it's more to tell the story of if commercial real estate and REIT sentiment is improving, why has that been, and what does that mean going forward, frankly, in 2026 and beyond? So I have a little slide presentation. We'll go through a little bit of it. We'll turn it off. We'll go back to it from time to time. But really excited to have you here with us, Sam. Thank you so much.
And thank you for having me. Really appreciate it and looking forward to today.
Well, obviously, you know how we on Wall Street are governed by the world of compliance. We have this little disclaimer slide that we have to show so that we can make sure that we're covering our compliance obligation. But, let's talk about Hazelview. $11.4 billion dollars as of September 30th. Been around since 1999. They take a very hands-on, active approach in ownership. They're really very unique in the way that they do things. At least I think that they are. Sam, who again I've known for many years, has been at Hazelview for happy almost 13th, 14th anniversary here, based in New York City. I know Sam from back in his days at Forum. Hello, Russell and the team, if they're watching this today. And Sam and I are also connected through some connections at University of Michigan, and he is a proud Wolverine graduate. So let's kick this off, Sam. Obviously,
Yeah.
to start off this conversation, you have a really good presentation today. I've shared the link with folks. You could find it on the Hazelview website, their 2026 Commercial Real Estate Outlook. Everything that I'm presenting today in this presentation is directly from that. So, first things first, what did we learn about in 2025?
Yeah, I mean, for 2025, REITs lagged the broader market. It was the fifth time in 6 years that the asset class has underperformed. And specific to 2025, it was the combination again of higher interest rates, but this time trade policy that weighed on valuations. And that was all despite the fact that real estate fundamentals were pretty resilient. Now, as the year progressed, right, those trade headwinds began to ease and monetary policy became more accommodative. So that did support an improvement in financial conditions, and it did lead to a rebound in REIT share prices and stock prices in the third quarter of this year, and you can see that in the graph. Now, REITs continued to rally into the early part of the fourth quarter following those initial cuts by the Federal Reserve, but renewed uncertainty around the pace and what that would look like going forward resulted in modest pullback to end the year, and you see that in the graph on the slide.
Um, let's talk about some regional performance. You know, I guess we can maybe kind of fold in here a little bit of a mix. There is a REIT that we all follow that frankly does have a global worldly presence
Yep.
that kicked off earnings season this morning. Good old
It did.
Prologis.
It did, yeah.
Prologis. Congrats to Dan Letter, by the way, now assuming the infamous role that Hamid had done for many years. So I want to keep in the back of our head going through this, thinking about Prologis, just because it is the first guy to kick off earnings. I don't know how much you could talk about it since it is so fresh. Um, but let's talk about some of these countries, because it's interesting to see what jumped out, and I'm more curious as to the why some of these countries perform so strongly.
Sure. Yeah, let's touch upon the countries and then we can weave back into PLD, and then being kind of, having a footprint obviously across North America, Europe, and Asia. Um, so, as we can see on the slide, Asia was the best performing region in 2025, and that was led by Japan and Hong Kong. So in terms of the why, with respect to Japan, higher inflation was a big driver of stock price performance because what that allowed the companies to do was for the first time in a long time pass through strong rental rate increases. And we saw that in office, we saw that in hotels, we saw that in the residential sector, and that pushed up share prices throughout the year. Now, C Corps within Japan, which are not REITs but have a different tax structure, they materially generated stronger gains. They were up 40% plus. So they outperformed the entire market overall. And part of that significant outperformance was driven by corporate governance and share buybacks, two elements we see a lot in the US, but we're starting to see more rigor in companies outside the US. Now, Hong Kong was up 31.5 last year. Hong Kong experienced a positive inflection in investor sentiment towards real estate, and that was also supported by lower interest rates and improving financial conditions. So if you think about when the pandemic started, sentiment towards China, sentiment towards Hong Kong, and in particular real estate in those two markets were very negative for a long time. That shifted in 2025 and led to outperformance of the Hong Kong market. Um, the UK was also another market that outperformed and outperformed the continent pretty considerably in 2025. The continent faced headwinds in the back half of the year from weaker economic growth and a pause in rate cuts by the ECB. Last but not least was the US, bringing up the rear, generating a total return of 2.7%. So obviously significantly worse than most other real estate markets around the world and significantly lower than what the broad market experienced. In terms of the why, I think part of it was around monetary policy and interest rates remaining higher than anticipated throughout the balance of the year, especially relative to other markets like Canada, like the UK, like the continent, where their central banks were easing rates. And that weighed on investor sentiment for the market. We also saw outflows. There were 2.7 billion of capital that flowed out of the REIT sector. So that put sustained pressure on share prices. Now, as it relates to PLD and their global footprint, the stock actually outperformed pretty handsomely last year, right? I think it was up over 20%. Part of it was driven by a recovery in leasing, a recovery in industrial fundamentals in the back half as those trade headwinds eased. And I think part of it that pulled up the shares was some of the performance in its other markets, which helped sentiment for that global footprint, that global portfolio.
Can we go back to a point that you mentioned about corporate governance, excuse me. How does, I'm trying to connect the dots here. How does corporate governance push share prices? I can understand certain things that, here domestically, what companies do to be more corporate governance friendly. But how does that translate directly to the stock price? Help me fill in the gap there.
Yeah, it's a good question. So for a long time, the Japanese companies, in particular the C Corps, have not been, to your point, shareholder friendly. They have not been transparent. They have not shown the strategy around maximizing share price, maximizing earnings, and making asset allocation decisions and capital investments with the intended purpose of maximizing ROE, ROI, and driving earnings. LE Investment got involved in a couple of companies in Japan last year that put pressure on management, that put pressure on the board to refocus the capital decision-making efforts of the management teams to be more shareholder focused. And as we've seen, that capital allocation decision is the number one decision that most REITs have an influence on as it relates to strategy, investment, and driving growth. The Japanese companies have been absent in that mind frame, and that changed a lot last year, where you had companies trading at low multiples that started to become more friendly with their focus on maximizing shareholder value, and that caused a re-rating in the multiple in the stock prices.
But you did hit on a very important point, and we see that here monthly, quarterly, is that activist investors were pushing these REITs to do it. The REITs did it, and then investors are buying into the potential changes in future, and thus that's what boosted the share price. So it
Yep.
was from the help of investors forcing the company's hands to become more corporate shareholder friendly, which is then what where we got to today. So that's interesting. Elliott, of course, I should have known it was Elliott. Um, all right, so we've got a boatload of sectors across the globe. And
Yep.
obviously, I know we're going to be talking about healthcare a lot, but let me reshare the screen here because we're talking about it. You say, guys, 36% return in healthcare, um, which is staggering versus hate to throw Alexandria under the boat here, but 46% underperformance. I mean, that's 80 plus percent spread there between top and bottom. That's massive.
Massive,
Let's
massive.
talk about the sectors.
Yeah. So, we can start from the top and work our way down. I mean, certainly healthcare was a standout, like you said. Part of what drove it was what was demand and the maturation and the growth in the 80 plus age cohort that is needing more care as they age. So from a demand point of view, traffic is up, interest is up, inquiries are higher, and we're seeing that come through with higher occupancy rates for the industry. On the other side of the coin, supply, new construction starts are at decade low levels. And that is what's contributing. That's demand supply imbalance. That's what's contributing to material gains in occupancy, rental rates, and NOI margins, which have drove earnings higher throughout the year, leading to robust performance in stock prices. Welltower, which is the industry leader, was up roughly 50% last year. That's 50. Sonida Senior Living was up over 41%, and Ventas was up approximately 35%. On the flip side, you talked about, yeah,
Wait. Let's talk about Sonida because that's not a name that gets talked about a lot by, as far as I know, a lot of the REIT folks, or maybe by a lot of both retail and institutional investors that may not be familiar with them compared to Ventas or Welltower. So, can you share a little bit of that story for us, real quick?
yeah, it's a company that is in its growth phase. They own a portfolio of high quality senior housing throughout the country. They both own and operate their communities compared to Welltower and Ventas, who own the communities but outsource the operations to other entities. Sonida Senior Living has gone through a transformation over the last 3 years. They have righted and fixed the balance sheet. They've positioned the company for growth. They've replaced the management team with a very high quality C-suite, and they are in the midst of a merger, which is going to significantly increase the market cap of the company by 3 to 4 times, which is going to enhance the liquidity profile of the stock and allow new investors to buy in. It's one that we, think whose valuation is substantially discounted relative to its peers and have significant multiple expansion potential over the next 12 to 24 months compared to the group overall.
Correct me if I'm wrong. Ticker is SNDA. Is that correct?
Yep. Yep.
Some good stuff there. Thank you for that. All right, so let's keep going. I apologize. I didn't mean to go off on a tangent there.
No, not at all. I mean, you started with kind of the dispersion and return, and the other end of the spectrum is life sciences. So again, the weakest of all the property types out there. You talked about Alexandria, whose stock price was down 46%, like the antithesis of senior housing. So you have elevated supply levels, right? I mean, supply is increased meaningfully from mid to low single digits 3, 4 years ago to almost 30% on an availability basis in its core markets of Boston, San Diego, and San Francisco. At the same time, demand has declined a lot. That's weighed on occupancy rates. It's weighed on rents. its rate on TIs, so TIs and listing commissions is higher, and it's been a struggle to lease up their new projects. Um, and that has caused the stock to, go to decline the way it has, which has really impacted their cost of capital.
Let's talk a little bit more about that because obviously we both know there's a couple of other office REITs that do play in that space. Kilroy, obviously, Boston or BXP. Other office REITs that play in that space.
For now, we're still think there's softness around fundamentals that are going to persist in
So this
20,
overhang will stick with those two other companies, you think?
certainly around life science as an asset class. Don't think the bottom is in just yet. We are getting there, but we don't see market rents having hit that bottom. New supply has probably done so, but demand continues to remain soft.
I think it's going to be a very exciting conference call this quarter from them. It's interesting when you look in kind of the middle part of this. SFR down 10% last year, clearly in the crosshairs right now. Headlines coming out every single day, and we could spend 30 minutes, an hour on that topic alone. Well, which of these sectors in particular really kind of caught you by surprise as you were doing your analysis of the performance?
Yeah, I mean, you talked about SFR and in general, residential stood out or short lease duration property type. So you could lump in self-storage in there, hotels, multifamily. I mean, in general, anything housing related didn't necessarily work. Part of that was driven by an unanticipated softness in demand that happened with jobs and less job creation than anticipated as we went on throughout 2025. Supply was also a headwind, right? We keep talking about supply and demand, and it really is that basic when it comes to assessing the health and attractiveness of a property type. So there has been excess supply in the build-to-rent community that's impacted single-family rental fundamentals and pricing power. There has been significant amount of construction starts and deliveries in the multifamily space, particularly in the Sun Belt market, such that new lease spreads are negative. So the combination of weakness in pricing power, weakness in demand that was more pronounced than anticipated resulted in the stocks lagging in 2025.
We'll move ahead here, but if I had to put you on the spot real quick, thinking about this 80% variance that we're looking at in your chart, again, just a quick shot. Do you think the 26 chart is going to be just as wide, or do you think the performance will be a little bit tighter on a sector by sector basis if you had to project?
It's a great question. 80% is historically a significantly wide variant. Traditionally, the variant is very wide. So when we say very wide, plus or minus 40 to 50%. So there is a big dispersion that typically happens every year. You just don't know going into every year exactly which property type will be at the bottom and exactly which property type will be at the top. But I do anticipate if we're doing this call this time next year and we're looking at the same chart, we're going to see a variance somewhere around 40 to 50, probably not 80.
Well, we will be scheduling that after this call for next year, so don't worry. All right, let's talk about 26. We're going to tee it up in your market outlook. You have three bullet points that you guys are highlighting. I'm just going to verbalize them. We'll
Yep.
keep the screen off for a second, but you can talk about it. Performance and context. We're finally past COVID,
Yep.
and it's a different world, but yet a lot of people still look at REITs through COVID lenses. The fundamental setup, which I think is, again, we could spend an hour on that topic alone, and then looking at valuation. So you guys are basically looking at performance, fundamentals, and valuation. Which do you want to hammer home first?
We can start with valuation if you want to. I mean, effectively, valuations today are some of the most attractive they've been in years. And we're going to talk a lot more about that. But the valuations that we see, both on an absolute basis and a relative basis, are very, very attractive. You're showing a slide here. Also, kind of the next thing to tee up is fundamentals. We went through a number of the nuances around different property types and the fundamentals around those property types. The industry's in great shape, right? New supply, we talked about declining across most property types and in most geographies, and demand has remained resilient. And that's why we see occupancy rates where they are today at or above those historical levels. And we expect that will persist in 2026.
I didn't mean to jump ahead, but I thought this chart was really important because it talks into the valuation angle.
Yep.
What really jumped out at me is that literally occupancy has been flat over that 25 years. We're at that same point. By the
Right.
way,
And the
93, 94% occupied is a strong number. Like people are like, oh my gosh, they're only 94% occupied. And I'm like, I take a different approach. I go, wait a second. You own 100 apartments, 94 are occupied. That means you can only lease six at market rate right now. You have a cushion of rental stream there. If you were 60% occupied, that's a completely different story. But when for us, 93, 94, 95 is for a lot of these industries are almost sectors are almost considered fully occupied at that point when you've only got a couple of units that are coming up every month, correct?
Absolutely correct. And we're seeing it across most property types. And that is what has given landlords the ability to be able to raise rents on expiring leases.
When you especially get like at the retail side of it, what the retail leases are looking like these days, because there's been no new development
Yep.
in some of these other sectors, it's staggering. All right, now comes the fun part, because now we start looking at some of these sectors that are going to stand out, or like, what you guys are calling as standout picks for this year. And we've got about six or seven of them that I'd like to spend. Even like Germany, like I was interested to see Germany because that really jumped out at me. So obviously industrial, that freight train isn't slowing down anytime soon. Walk us through because it's a great chart that you put up here. Talk us about why industrial.
Yeah, look, we think the sector will hit an inflection point in 2026. We think vacancy rates have peaked. Leasing demand is finally picking up post the lull that happened around Liberation Day. Decision making is becoming more swift, and new supply, as you can see in the graph on the left-hand side, that's coming down significantly. The combination of new supply between 22 and 23 that led to record deliveries of over 700 million square feet, or approximately 6% of the existing inventory, really weighed on market rents. And it also weighed on vacancy rates. It caused the national vacancy rate to increase from a record low of roughly 4% to the mid 7% range of kind of where we are today. Now, that supply backdrop is shifted and it's becoming more favorable. And today, when you look at the construction pipeline, it's down to 200 million square feet, or just 1.6%, 1.9% of existing inventory, the lowest in a decade. So we think that's going to be beneficial to the market. We think those vacancy rates are going to start to come down. We think that companies are looking through the geopolitical noise to take up space and kind of think more longer term than shorter term, which is what happened last April. Um, and we think the sector is poised to outperform in 2026.
Can I ask for a couple of, I'm not saying buy, sell, hold, but a couple of names, both domestically and let's say in some of these markets that you guys are watching in case somebody wanted to check it out?
Yeah. So you talked to earlier, you asked about Prologis. We like Prologis. We think the setup for next year is pretty good. The company came out today, they had their earnings call. We think 2026 FFO core guidance is conservative. Their same-store NOI guidance was better than anticipated. They're expecting occupancies to tick up, so that aligns with what I said earlier around vacancy rates coming down for the market overall. We think the company will continue to drive growth through new development starts and contributions. And we think the shares are poised to deliver better performance throughout the year, which will lead to the share price doing pretty good. We also like East Group. We think that those Sun Belt markets, which is core to the company's footprint, is going to lead to a better leasing environment, more development opportunity, and the ability to exceed investor expectations. Outside the US, there's a company in Europe called CTP. CTP is the largest owner operator of industrial properties in the CEE, and they are expanding their footprint to Western Europe. We think the opportunity set for growth, again, through new development, through injecting properties into modern industrial real estate into a market that has tenants that are looking for that type of space, should do really well. And then lastly, in Asia, there's no coincidence, there's a company in Japan called Nippon Prologis REIT. We think that company is poised to see a recovery in market rents, and that's going to lead to better growth throughout 26 and going to 27.
I gotta ask, we have Fibra Prologis that's in Mexico. You just mentioned Nippon. What's Where does that stand in the landscape of Prologis? Are they separate traded entities? I mean, obviously they're separate entities, traded entities, but where does that fit into the global umbrella of the company?
Yes, completely separate entities, separate companies. Nippon Prologis in Japan has an affiliation with Prologis, and they share services, so to speak, that supports the J-REIT that is listed in Tokyo. But outside of those shared services, the companies are completely separate entities.
Good to know. All right, Germany and Australia residential. Now I
Yeah.
know you and I've been talking about this because again, this is very unique. I haven't heard this one.
Yeah, so it's again two different opportunities within the world of residential real estate. Um, Maybe first with respect to Germany, since we have that graph on the left-hand side of the slide. The idea here is that the fundamentals in the market are supported by two things. One, it's chronically undersupplied. There is a supply shortage of affordable housing in Germany. And at the same time, you are experiencing sustained population growth in many urban centers. So the chronic supply shortage, the sustainable population growth, that is underpinning mid-single digit rental growth across the country. So we think that has a lot of runway to it. And we look at where the stocks are trading, particularly a company like Vonovia, and we think the stock is just too cheap compared to what the value of the underlying real estate is and what the growth profile of the company is going to look like over the next 24 months. Australia is one of the things that the segment of the residential market that we like in Australia is actually in the manufactured housing space. So in Australia, they call it land lease communities. Again, powerful demographic tailwinds, another structurally undersupplied market that is having affordability challenges. And there is strong demand from in-migration and from domestic population growth for that price point housing. And as retirees increasingly look for more affordable housing options, and they're looking to preserve capital, they want predictable living costs. We think that manufactured housing community is really well positioned to benefit from an influx of demand for that type of product. So it's something that, it's an area of the market that we really like for in 2026.
If Marguerite, Charles, or Sam are watching this, let's talk. Maybe there's an opportunity to expand in Australia.
Right, exactly, exactly. Happy to jump on the line.
All right, so obviously we've talked about a little bit about senior housing and healthcare, and you guys obviously think that this is can continue to skyrocket. Well, I don't want to say skyrocket, but it's going to continue to grow. Real quick, one thing that I like to point on here, you talked about the lack of new supply, and I think about, frankly, that consumer, our age group, 25 to 50 years from now, that's going to be living, that community doesn't exist. The modern community, with all the technology and amenities that we've grown accustomed to, doesn't exist. And so when I talk about senior housing or, this sector with folks, I tell them to look at it with a 25 to 50-year window because
Hmm.
it is going to look completely different, I think, than what it does today.
Yeah, completely agree. And that's one of the reasons, even though we talked earlier about some of the stocks performing so strongly in 25, those tailwinds, they're not just a 12-month story. It's not just a flash in the pan. The the supply being so low as a percent of existing inventory, that is not going to change in the next several years. New construction starts are at and will remain at multi-decade lows. Part of that is due to higher financing costs. Part of that is due to higher hard costs. Part of that is due to labor costs have been higher, and there's been lengthy delays around permitting and entitlements. So if you don't have the ability to construct and develop new communities, then all that wave of demand of the baby boomer generation and the need for higher acuity is going to get funneled into existing communities. So when I spoke earlier about occupancy trending towards 90%, rental rates in the mid-single digits, NOI margins expanding north of 30%, that is that's what that's what we believe we're going to see over the next several years. And that level of long-term growth potential, in our view, is not yet fully reflected in current pricing, especially for a company like Sonida Senior Living.
What about other players? For us here in the States, one of the biggest stories of the past couple of years has been American healthcare, AHR.
Yep.
Obviously, again, take a step back. A lot of these play across multiple sectors, hospitals, medical office, all this other stuff. We've seen some consolidation. I think we're going to be seeing a lot more consolidation personally. But, it's interesting that you mentioned Sunita. Again, like I said, it's just not a name that stood out, but maybe we really need to start watching it more closely. But what are some other names that are on your radar, both here and in Canada, that jump out at that we should be watching?
Yeah, another name, again, let's take the Canadian example. Chartwell. Chartwell Retirement Residence. I mean, that is a company that, they're one of the leaders in that market of owning senior housing and nursing facilities. They are, we talked about, or I talked about earlier about margins in the US kind of pushing up to and through 30%. They're pushing margins and achieving margins north of 40%.
Wow.
Occupancy rates are approaching mid 90%, not just the high 80s of where they are today for the US industry. So we think the opportunity in Canada with a company like Chartwell is really strong operationally, but they also have a cost of capital advantage, right? The outperformance, the increase in stock price has allowed these companies to be able to issue equity accretively to buy assets, buy portfolios that have been undermanaged, unloved, and use their operational prowess to drive growth higher and above what you would see at a stabilized community. Um, so that's kind of, one area of the market in a different geography that we think will lend itself to pretty strong returns in 2026.
Okay. The next slide that you guys mentioned is data centers.
Yeah.
Now, as I've said multiple times, we could spend an hour on data centers alone.
Yeah.
AI. I always, and in my interviews, I always talk about you're watching this interview right now on YouTube. You're probably, utilizing a data center REIT to be watching this. So you mentioned U.S., Singapore, and Hong Kong.
Yep.
What
Yeah.
jumps out?
So
I want to talk about more about Singapore and Hong Kong. Again, think about this from a global angle. So Why there versus, let's say, Europe or under other countries, and then we'll fall back to the US.
Sure. So, we think, look, data centers is a global business for sure, right? When you look at their customer bases of companies like a Digital Realty Trust or an Equinix, I mean, so much of their leasing is coming from repeat customers and it's happening within their global ecosystems, within their portfolios. Um, the markets you mentioned, let's take kind of Hong Kong as an example. There's just a scarcity of land, and the scarcity of land with elevated construction costs, that is resulting in the hyperscalers, right? The Metas, Oracles, Apples, Microsoft, Amazons of the world. It's forcing them to lease capacity from existing owners, not to be able to develop on their own balance sheet, which is what you see a lot of what's happening in the US. 50% of international data traffic that enters China flows through Hong Kong. So Hong Kong as a city is a really important piece of the Asia Pacific data center ecosystem. But so is Singapore, right? And there's a lot of demand for connectivity in Singapore because of subsea cables. Uh, Singapore being an island is very tight in the way of supply because you just can't build more on an island because a lot of those land is utilized already. And that's resulting in rental reversions on existing leases in the 40 to 50% range. 40 to 50% increases on existing leases as they come due. So we like that dynamic. And then the US, of course, is the data center capital of the world, right? I mean, when we read the newspaper articles and the headlines and listen to earnings calls from the hyperscale companies and read about CapEx and CapEx for growth, those AI models, they're scaling to unprecedented levels. The demand for computational infrastructure is surging. And that is leading to this ferocious appetite of power that just is not readily available on the grid. So what is available is getting consumed, it's getting occupied, and that's leading to vacancy rates in the market dropping to historic lows. I mean, 10 years ago, 20 years ago, vacancy rates in the data center world would have been mid-teens. Today, as of the end of the third quarter, they're 1.6%.
Hmm.
1.6%. So when you're in a market that is effectively fully occupied, that's resulting in the ability of existing operators to have pricing power. And that pricing power is driving market rents, and those power challenges with grid capacity, labor shortages, are leading to multi-year development lags. So you can't build this stuff fast enough. And that the imbalance is what's creating a really strong real estate market around data centers today.
I mean, we saw it in the last 2 weeks of the year with Digital Bridge going away. So
Yep.
clearly it shows that power demand. Do you think Blackstone spins back out QTS to play into that strength of the sector?
Don't know. History will show that it has a tendency to take companies private and possibly spin it back out. Like, let's look at what happened with Hilton as an example.
Of course. The
So
key.
possibly, um, it could be one of the exits that obviously they will look at.
Okay. So now let's get a little bit from a different perspective. We have global perspective. The key thing is all about jobs. Do you think employment growth benefits the REITs? Do you think we start seeing employment growth, and how does that translate to the bottom line?
Yeah, it's a great question because it is the found one of the foundational elements to what drives and creates demand for real estate, right? So more jobs is leads to more consumer spending. That's better real estate fundamentals for retail and hotel. More jobs mean more office using employment, which should translate to better demand and more demand for office space. More jobs, greater ability to afford housing, right? So higher demand for apartments or single family rentals. And if more jobs are being created, maybe you see more mobility. More mobility means more demand for storage. So I think jobs are a key piece of the demand equation. And it's something that I think everyone within the world of real estate tracks very closely.
I mean, it's called that trickle down effect, right? It
Yeah.
trickles across, frankly, every sector if you look
Yeah.
at it. What about AI? Does AI benefit or does it hurt commercial real estate in the REITs? And then also, we talked about data centers and you briefly touched upon power. And I think that's something to think about because think about how much power is consumed in AI searches. We could point to the Fermi IPO. There's stories that are out there. I think at this point, it's not about the data center, it's where the power is coming from.
Yeah.
So, what's your thoughts about that?
So I think there's a lot of debate on this topic, right? A lot of debate. Will AI help or hurt commercial real estate? There's two sides to the coin. On the positive side, right, AI will lead to greater efficiencies for companies, which should result in margin improvement and better profitability. So that's good with respect to if you're a public company, leading to a more advantageous cost of capital and then using that cost of capital to reinvest. On the negative side, it's estimated that one study has shown that 37% of all the tasks that happen within the commercial real estate services sector is capable of being automated. So you would think over time that would likely lead to some job displacement. Now, AI in and of itself will create the need for new jobs and new roles that are not yet present. And we'll likely see some displacement as well. So I think the answer is it's both. It will help, but there are parts of the commercial real estate world where it will also hurt as well.
It depends. How about tariffs? Obviously, we're still getting story with tariffs.
Yeah,
Hasn't gone away, not
right.
going away. What's your
Yeah,
thoughts about tariffs and the impact on REITs, domestic and global? But now let me give you my 2 cents on this because I like to butt heads with you sometimes because I think it's one of those good topics. I've said you're a landlord, you're Kimco or whoever it is. Your job's to lease the space.
yeah.
Tenants sign a lease with you. The tariffs impact your tenant. Kimco isn't impacted by tariffs unless they're out there building a new property. And thus some of those materials go up and things like that. But I've been saying, the landlord is not directly impacted by tariffs. True or false?
I would say part of it is true, part of it is false.
It depends.
It depends. So the answer is it's both, right? So the way what you laid out is the tenant may be impacted negatively, which impacts the landlord.
Yes.
Directly, it may not impact the operating piece of that real estate. So obviously, when it happened, last year, Liberation Day, the tariffs, everyone thought initially it would impact industrial real estate. And we saw that in terms of the decline in the stocks, sentiment around industrial real estate decision making when it came to executing new leases and making space decisions, right? So we saw a delay around that. Now we're through most of the noise, even though there is still noise on a daily basis that happens. And I think people have become a little desensitized to the noise. And we're starting to see customers look through that and leasing activity is picking back up. So I think as an industry, we're through the worst of it. I think the impact has not been as great as people anticipated. The concern around the impact on growth and inflation has yet to really be manifested in its worst form. Um, and the market has continued to remain resilient throughout. So
You've thrown a lot of good stuff at us. And one of the questions I want to hit on is how do you guys do your approach? What makes Hazelview unique when you guys approach? We'll focus on the public side because private's a whole different world.
yeah.
But how do you guys focus on uh, your approach with the public traded REITs?
Yeah, it's a great question because we do things a little differently. What we do is we take a 2 to 3 year view in our in every investment we make. So we think about it from a mindset standpoint. We are long-term investors and we underwrite with a forward-looking view in mind. right? So we're big believers that, people plus process create outperformance and outstanding results for our clients. And when we construct our portfolios for our strategies, we demonstrate a very high conviction mindset. So what that means is our collection of investments, in our view, represents our best ideas in the world. If we like it, we don't own it. If we love it, we may own it. So we have to have strong conviction that the company, the strategy, the execution, the capital allocation, the valuation are all going to lead to stock price outperformance. We also have an insane focus on risk. So we've created two proprietary risk models that we've been utilizing for multiple decades. One is focused on the company aspect of things, and one is focused on country factors because we are investing in the world, around the world, and we need to ascertain how do we distinguish 20% upside from a stock in Australia and compare that to a company in a different property type in Europe, and then compare that to a different property type in the US. So we're focused on risk as much as we are return, and we utilize a two-pronged valuation approach. So we leverage NAV and cash flow. Cash flow is in relative AFFO. NAV is not spot. So you look at a lot of the NAVs in the market that people publish. They publish most recent quarter analyzed, forward 12 months. We're looking past that, right? Our view is the market today is already looking at what the next 12 months worth of earnings are going to be. We want to be one step ahead of the market. In order to do that, you got to look 24, 36 months into the future. And that's the lens with which we invest, and that's the lens with which we underwrite. And in order to be able to identify the opportunities around the world, you got to have people in those locations, right, that are close to the market, that are close to the fundamentals, because real estate is such a micro market type of industry, right? The demand and supply impacting those fundamentals are so adjacent to what's happening around those buildings. So that's how we try to identify the best opportunities in every sector is by having people on the ground and having and utilizing this two-pronged valuation approach through a forward lens.
People plus process creates
Equals
outperformance.
creates outstanding performance. Yep,
Outstanding performance.
that's our
I,
motto.
I, I like that. I'm going to put that on my wall if you're okay with that. Besides Michigan football, what keeps you up at night these days?
Um, well, there's a lot there we could get into, but kind of we'll save that for another kind of telecast. I would say it's really about the things we can't control, right? So it's about those exogenous factors, those economic shocks, maybe something policy induced. Maybe it's an uptick in inflation that leads to a reversal in central bank policy and a pivot in rates higher, not lower. So it's what we can't see around the corner that will likely have the biggest impact. And that's what keeps us up at night.
So, to bring a nice close to it, I had the question of what is the value proposition of investing in REITs in 26 and beyond?
Yep.
And instead, I figured I would go to your conclusion slide that you guys have because I think it puts a pretty bow on this whole conversation. You want to kind of walk us through here what the value proposition is?
Yeah, for sure. I mean, look, I think for 26, it is fairly simple. It's we talked a lot about fundamentals and it's about valuation. REITs, at the end of the day, are just too cheap to ignore. Um, we've had, as an industry, an atypical, an atypical time period of underperformance in 5 of the last 6 years to start this decade. COVID kicked it off, right? It called into question the viability of a lot of property types. And then 22, 23 happens, acute increases in interest rates, the largest in 50 years, driven by a significant period of high inflation. It really impacted the sentiment and the psychology around owning real estate. And because of that, valuations have been washed out. The sector today is the most underowned it's been and the most underowned relative to any other S&P 500 sector. Multiples have compressed by over 30%, and the stocks in our valuation lens are trading at 17% discounts to intrinsic value and offer 20% upside. And that's without even being, I would say, um, aggressive in any of the underwriting. And when you look at it today, the combination of significant discounts, cheap valuation, resilient demand, and declining supply, that is a really good recipe for success. And we think kind of it all lines up and every box gets checked for 2026.
Do you remember those toy cars that you could buy where you would like pull it back and it, like as once you get to a certain point, you put it on the thing and it goes.
Yep.
Like hearing you talk about this feels like that's that car right now over the past few years, and it's about to be let go on the track.
We think so. We think so. And it's, we've had a number of false starts, right, in 24 and 25 as rates remained higher for longer, inflation remained a problem. Those two variables seem to be more of a tailwind than a headwind today. And then obviously the fundamental landscape is lining up pretty good. Um, and real estate as an asset class before COVID, if you go back to the 2010 decade, right, the 2000 decade, the dawn of the modern REIT era that really started in the early 90s, I mean, the asset class generated low double-digit annualized returns, right? 10, 11, 12, 13% every year. That has not been the case in the past six. Um, and we think there's obviously an element of reversion to the mean. And then there's an element that finally, maybe some of these twin shock events that happened over the past 6 years are finally starting to work its way through the system and it's behind us. And it took a lot longer for that to happen than anyone anticipated, which helps explain why the performance out of the asset class has been so poor. And oh, by the way, at the same time, you have this thing called artificial intelligence. You have the Magnificent Seven. You have growth in earnings in the broader market. So it's been a perfect storm with respect to what hasn't worked in the real estate and what has worked elsewhere. We think that starts to change in 2026.
Sam, mark your calendar for January 21st, 2027, because I can't wait to come back a year from now. And fingers crossed, I hope it all plays out the way that we're talking about this. I can't thank you enough for spending your time and sharing it with us and just dropping a lot of good global wisdom with us. I learned a lot today. Sunita, Lanovia, Chartwell, some really good stuff here. CTE, I think you said as well.
CTP, yep,
CTP.
yep.
So I can't thank you enough for this. We really appreciate it.
Well, thank you for having me, and I look forward to doing this in the future.
Thank you.